Hello everyone, Professor Christensen here. This video is all about depreciation. And it's going to be depreciation just in its simplest form, which is going to be straight line depreciation. So if you need something else, we'll have to look at a different video. All right, so what is depreciation in accounting? Depreciation in accounting is all about allocating the cost of an asset over its useful life. So a lot of people think that depreciation has to do with decreasing in value, which is what depreciation means in regular conversation. But in accounting, we're talking about allocating the cost of an asset over its useful life. Think about buying a truck. We're going to look at a truck example in a minute. Think that a company buys a delivery truck. Say that you're an auto parts store and you're delivering parts all the time. So you use your truck to earn revenue. So if you buy a truck that costs you $55,000, you're going to record that as an asset. But that truck is going to help you earn revenue, say, over the course of 5 years. So we want to put the cost of that asset into the 5 years that are going to benefit it. And that's what this is all about. Okay? All right, so straight line depreciation is the most common. And what straight line depreciation does is it gives you every year the same amount of depreciation. Okay? So straight line means every year you take the same amount of depreciation, assuming it's a full year. All right, so this is the formula that you have to remember if you're going to be doing straight line depreciation. You take the cost of the asset minus its salvage value. The salvage or residual value is the amount of money that we think the asset's going to be worth at the end of its useful life. It's only an estimate, right? And then we divide that by estimated useful life in years. Okay? Now, make sure when you're dividing, by the way, remember order of operations. So make sure you take the cost of the asset, subtract your residual, get a subtotal that's called your depreciable cost, and then divide that by your estimated useful life in years, and that gives you your depreciation per year. Now, if you have less than a year, so say you buy your asset on November 1st, and you're only going to depreciate 2 months in that year, if you have a December 31st year end, in that case, you have to take your depreciation per year and multiply it by, say, 2 over 12. Okay? But the example that we're going to look at today is just a simple example, and it shows full years of depreciation. Okay? All right, so let's see what we have here. So we have a truck. We buy a delivery truck. The truck costs $55,000. We think it's going to give us service for 5 years. And at the end of the 5 years, it's going to be worth $5,000. Okay? Now, remember what we said. Our straight line depreciation is cost minus residual value divided by estimated life in years. So our cost is $55,000, right? Minus residual, divided by useful life in years, 5 years. All right? That is going to give us our depreciation per year. So take 55,000 minus 5, that gives you 50,000, divide by 5 years. That means we're going to depreciate $10,000 per year. Right? That is our annual depreciation. All right, so every year we're going to take $10,000 of the cost of this truck into expense. All right, so now let's see what our balance sheet looks like, and then we'll look at our income statement. Okay, so our balance sheet is going to show every year $55,000 for equipment. So it's shown at cost, okay? All right, so every year it's showing $55,000 cost. Now, in the first year, we took $10,000 of depreciation. Let's just remind ourselves, what is the journal entry when you record depreciation? When you record depreciation, you debit, let's put it over here, you debit depreciation expense. So it's going to be $10,000. And then you're going to credit accumulated depreciation. Okay, depreciation expense, this is what's called an adjusting entry. And remember that adjusting entries that happen at the end of the accounting period, they affect one income statement account, that would be depreciation expense, and one balance sheet account, and that would be accumulated depreciation. Accumulated depreciation is what is called a contra asset account. I like to tell my students that a contra asset account is married to an asset. It can't be by itself. So accumulated depreciation cannot exist without the asset that's being depreciated. Okay? So contra means against. A contra asset goes against the asset. So let's see what that looks like. So every year, by the way, we make the same entry. Year 1, 2, 3, 4, and 5. All right? And we're assuming a perfect world where all of our estimates come true. All right? Not necessarily always true in real life, but for this example, we're going to assume that our asset lasts the 5 years and everything goes according to plan. Okay, so at the end of the first year, we have $10,000 in accumulated depreciation. Okay? Let's make brackets around this so you know that this is a negative amount. All right? So now our net book value, or our net equipment, this is called book value, is equal to those two added together or subtracted, right? The 55 minus the 10. So at the end of the first year, our book value is $45,000. Now, you're getting hit with all of these words that have different meanings than what you're familiar with. So you might think, well, book value is the value that my car's worth. When I want to find out how much it's worth, I go look at the book value. But book value here is cost minus accumulated depreciation. All right, let's put that over here. Book value equals cost minus accumulated depreciation. Now let's see what's going to happen to our book value as time goes on. What's going to happen here? So what's going to happen is, I want to make this a little bit smaller for you so you can, no, it's not going to work. It's okay. All right, what's going to happen is each year our accumulated depreciation is going to go up by $10,000. What's going to happen to our book value? It's going to go down by $10,000. Okay, so next year we have accumulated depreciation of $30,000. What happened to our book value? It went down to $25,000. Okay, again $40,000. Our book value is down to $15,000, and then in the last year we have depreciated $50,000, and our book value is equal to $5,000. Our book value in the last year of life is equal to, do you notice what it's equal to? I'm going to get rid of our truck because I want to write something here. Book value is now equal to residual value. All right. At the end of the asset's life, book value is equal to residual value. All right, so let's review what happened. We're recording $10,000 of depreciation expense every year. We debit depreciation expense and credit the accumulated depreciation. Our book value is going down every year by the amount of depreciation expense that we record. All right, that's our balance sheet. Now, on our income statement, we are simply going to have in our operating expenses, we have a bunch of other expenses. We have depreciation expense. How much is our depreciation expense? $10,000 every year. Doesn't change. Okay? Whoops. I don't want it to go up. Let's see if it's going to go up, or it'll give me 10,000. All right, there we go. So every year our depreciation expense is $10,000. Okay, and what happens, of course, is you probably remember that your expenses are closed at the end of the year. So that number goes away, and then the new year we record another 10,000 and another 10,000. Whereas the accumulated depreciation, that one keeps going up every year because that is a contra asset account. That is not an account that's closed. All right. Let me give you one other term, which sometimes you take your cost. So remember, book value is equal to cost minus accumulated depreciation. Sometimes we call this depreciable cost, okay, or sometimes depreciable basis. So depreciable cost equals cost minus residual value. Okay. What we're saying is, what are we saying? How much of this asset are we actually depreciating? Well, we're getting back 5,000 at the end, so we're really only depreciating 50,000, right? Because at the end we get, in the perfect world, we sell this for $5,000 and our residual was exactly equal to what we thought it was equal to. Okay? All right, so I hope that summary helps you with depreciation expense. Good luck in your accounting studies.